Meet Caroline. She is 64 years old. She lives in a nice brick house in Raleigh, North Carolina. She has a garden out back, a cat named Biscuit, and a rocking chair on the front porch she has been promising herself for 30 years. Caroline worked hard her whole life. For 32 years, she was a hospital administrator. That means she managed entire floors of a hospital. Doctors listened to her. Hundreds of people depended on her decisions every single day. She was good at her job, and she was careful with her money. She never touched her 401k, not once. Not even during the hard years, the years when her car needed work and the roof needed fixing, and both things happened at the same time. She kept adding to it, month after month, year after year. When she finally retired last year, she had $950,000 saved. $950,000. Her house was paid off. She had no debt. Her Social Security check was coming at $67. She and her advisor had a clean, simple plan. Take out 4% every year. That is $38,000. Add her Social Security of about $24,000, and she would have $62,000 a year to live on. More than enough. She was so proud. And she should have been. Most people retire with a fraction of what Caroline had built. Her advisor even showed her the research. He said, "Caroline, the 4% rule has survived the Great Depression, World War II, the 2008 crash, everything. It has never once failed over a 30-year period. You are going to be fine." And Caroline believed him. She bought new patio furniture. She booked a trip to see her sister in Portland. She finally let herself exhale. Then 2022 arrived. And 2022 was one of the worst years for retirement portfolios in modern history. The stock market fell almost 20% that year. Now, normally, bonds protect you when stocks fall. Bonds are the safe half of the portfolio. They are supposed to go up or stay flat when stocks go down. But in 2022, bonds also fell, about 13%. Both sides of Caroline's portfolio dropped at the same time. She lost about $180,000 in 1 year. And she still needed her $38,000 to live on. So she took it. From a portfolio that was already down. Her $950,000 had become $732,000. She was not panicking. She had the rule. She trusted the plan. But something was wrong. Something her advisor had never told her. The 4% rule was built for a different world. A world that does not exist anymore. And what happened to Caroline in 2022, taking money out of a falling portfolio in the very first year of retirement, is actually the most dangerous thing that can happen to a retirement plan. I am going to explain all of this today. Simply, clearly. And then I am going to show you exactly what Caroline did to fix it. And what you can do too. Let me tell you a quick story about where the 4% rule was born. Back in 1994, that is over 30 years ago now, a financial planner named William Bengen sat down with a big stack of historical data. He wanted to answer one question. How much can a retired person take out of their savings every year without running out of money? He looked at every 30-year retirement period all the way back to 1926, the Great Depression, World War II, the oil shocks of the 1970s, every bad decade, every good decade. His answer was 4%. If a retiree took out 4% in their first year, and then a little more each year to keep up with prices, the money survived every single 30-year period in history. Every single one. That is impressive. And it became famous. Financial planners everywhere started using it. It got into magazines, into calculators, into retirement planning books. But here is the thing. Mr. Bengen made 3 specific assumptions when he built that rule. And most financial advisors never tell their clients about those assumptions. Assumption 1. He assumed the portfolio was split exactly half stocks and half bonds. Not more stocks. Not fewer bonds. Exactly 50-50. Assumption 2. He assumed the retirement lasted exactly 30 years. Not 35. Not 40. He never tested what happened after 30 years. He just stopped the study there. Assumption 3. He assumed the retiree takes out the same dollar amount every year, just adjusted for inflation. They do not take out 4% of whatever the portfolio is worth each year. They take out a fixed dollar amount that they set on day one. These assumptions seem small, but today, in 2026, each one of them has a problem. And those problems add up to something important. Think of the 4% rule like an old stone wall. When Mr. Bengen built it in 1994, the wall was solid. It could hold anything. But since then, 4 cracks have appeared in that wall. Each crack is a problem. By itself, each one is manageable. But together, they make the wall weaker than most people realize. Crack number 1. Bonds are not working the way they used to. Here is what most people do not understand about bonds. In 1994, if you put money in a government bond, you earned about 7% interest every year. That is real money. If stocks went down, your bonds were making 7%. They were your cushion, your safety net. But then something changed. After the 2008 financial crisis, interest rates were pushed way down by the government. By 2021, those same government bonds were only paying about 1.5%. 1.5%. That is not a cushion. That is almost nothing. And then in 2022, bonds did not even stay flat. They also went down by 13%. So the thing that was supposed to protect Caroline when stocks fell, it fell too. The wall lost its first crack. Think of it this way. Imagine you are carrying an umbrella in the rain. But someone poked holes in the umbrella. You still have the umbrella, but it is not keeping you dry anymore. That is what happened to the bond half of the retirement portfolio. Crack number 2. Stocks are very expensive right now. There is a number that smart investors watch very carefully. It is called the CAPE ratio. Do not worry about the full name. All you need to know is this. This number measures how expensive the stock market is compared to how much money companies actually earn. When the number is low, stocks are cheap. When stocks are cheap, they tend to do well in the years ahead. When the number is high, stocks are expensive. And when stocks are expensive, they tend to grow more slowly in the years ahead. The normal CAPE number through history is about 17. Right now, in 2025, the number is about 35. That is more than double the normal level. What does that mean for you? It means the stock market may grow more slowly over the next 10 years than it has in the past. Not crash necessarily, just grow slower. Vanguard, one of the biggest and most trusted investment companies in the world, projects the U.S. stock market will grow about 4 to 6% per year for the next decade. The old 4% rule assumed stocks would grow at their historical average of about 10%. If stocks grow at 4 to 6% and you are taking out 4% every year, you are barely keeping pace. And when you add inflation on top of that, you are falling behind. The second crack in the wall. Crack number 3. People are living a lot longer now. This is actually wonderful news, but it creates a real planning challenge. When Mr. Bengen tested the 4% rule, he tested it for 30 years. He assumed people retired at 65 and planned for 30 years, to age 95. That seemed very conservative back then. But today, the average 64-year-old woman has a 50% chance of living past 87. For a married couple, the chance that at least one of them lives past 90 is close to 50%. That means many people need their money to last 35 or even 40 years, not 30. And the 4% rule was never tested for 40 years. Researchers who have studied longer retirement say that for a 40-year retirement, the safe withdrawal rate is closer to 3%, not 4%. Caroline retired at 64. She could easily live to 99 or beyond. Her money may need to last 35 years, the third crack in the wall. Crack number 4, the prices retirees pay go up faster than average. The 4% rule adjusts withdrawals for something called CPI, the Consumer Price Index. CPI measures how much prices go up for the average American family. But the average American family is not 70 years old. They are buying diapers and school supplies and car payments. They are not spending their money the way retirees spend money. Retirees spend a lot more on healthcare, on medications, on doctor visits, on assisted living, on services. And those things go up in price much faster than the general CPI. The government actually tracks a special inflation number just for older Americans. It is called CPIE. The E stands for elderly. And for decades, prices for the things retirees actually buy have gone up about 0.3% faster per year than the general CPI. That sounds tiny. But over 30 years, that gap adds up to a significant difference in how much you need to withdraw. And then 2022 happened again, where inflation hit 9.1%. That year, the things retirees buy went up even faster than that general number. The fourth crack in the wall. So let us add them all up. Bonds that no longer protect you. Stocks that may grow slower than history. Retirements that last 10 years longer than the rule was designed for. Prices that go up faster for retirees than for everyone else. Together, these four things mean that the 4% rule, used exactly as written in 2025, is riskier than most people realize. Not impossible, but riskier. Now I need to explain something that might be the most important financial idea in this entire video. It is called sequence of returns risk. That sounds complicated, but I promise, with a simple example, you will understand it completely in about 2 minutes. And once you understand it, you will never think about retirement money the same way again. Let me introduce you to two sisters, Elena and Vera. They are twins. They retired on the same day. They each took out $40,000 every year. And here is the remarkable thing. Over their 30-year retirements, they both earned the exact same average return on their investments. 7% per year. Identical. The only difference was the order in which the good years and bad years arrived. Elena got the good years first. Her investments went up nicely in the first 5 years. Her portfolio grew. By the time the bad years came, her account was big enough to absorb the drops without damage. Elena finished retirement with $1.2 million still in the bank. Vera got the bad years first. Right when she retired, the market dropped. She still needed $40,000 to live on. So she took it from a portfolio that was already shrinking. Year after year in those early years, she was taking money out of a falling account. By the time the good years finally arrived, there was not enough left to recover. Vera ran out of money at year 23. She still had 7 years left to live. Same average return, same withdrawals, same amount of money to start. But completely different outcomes because of the order in which the returns arrived. This is sequence of returns risk, and it is the reason why the year you retire matters enormously. If you retire into a bad market, like Caroline did in 2022, and you are taking withdrawals from a falling portfolio in those first years, the damage can be permanent, even if the market recovers later. Think of it like a bucket with a hole in it. If the bucket starts full and water keeps coming in, the hole does not matter much. The bucket stays mostly full. But if the bucket starts draining right away and the water slows down at the same time, the bucket empties fast. And once it is empty, no amount of incoming water brings it back. The first 5 to 7 years of retirement are the most dangerous. That is when your balance is at its highest. And that is when losing money, while also taking withdrawals, can do the most permanent damage. Caroline experienced this in year 1. Her portfolio went from $950,000 to $732,000 because of the market dropping and her withdrawal at the same time. Now she understands why. And now, so do you. Okay, now the good part. Everything I have just told you is the problem. And yes, the problem is real. But here is what I want you to hear clearly. This is not a hopeless situation. Not even close. Caroline is going to be fine. And here is why. Because when she understood the problem, she adjusted her plan. She did not need more money. She did not need to go back to work. She just needed to reorganize what she already had. And I am going to show you exactly how she did it. 4 simple adjustments. No complicated math. No exotic investments. just common sense. Applied in the right order. Solution 1. Keep 2 years of cash separate. This is the simplest and most powerful thing a retiree can do. Here is the idea. Before Caroline invested her retirement money, she pulled out 2 years' worth of living expenses. For her, that was $76,000. She put it in a simple high-yield savings account, one that she never touches when markets go down. Why 2 years? Because in every major market crash in U.S. history, the 2008 crash, the dot-com crash, the COVID crash, the market either recovered or stabilized within about 2 years. So if the market drops, Caroline does not have to sell any investments at a loss. She just lives off her cash for a year or two while the market recovers. And when markets come back up, she refills her cash from her portfolio gains. That cash account is her shield. Think of it like keeping enough food in the pantry to last 2 years. Even if the grocery store is closed for a while, you are not going hungry. You just wait until it opens back up. Then you restock. Caroline sleeps better at night because of that $76,000 sitting safe in the bank. No investment risk, no market exposure. Just 2 years of her life, safely protected. Solution 2. Use flexible guardrails, not a rigid rule. The 4% rule is rigid. It says, take the same amount every year no matter what. But real life is not rigid, and a rigid rule applied to a changing world is how you get into trouble. The guardrail system is much more sensible. Here is how it works. You set a starting withdrawal rate. Let us say 3.8%. Then you set 2 guardrails, one on each side. If your withdrawals rise above 5.5% of your current portfolio, because the market dropped, you tighten your belt a little. Cut your spending by 10%. Maybe skip the vacation that year. Eat out a little less. If your withdrawals fall below 3.0% of your current portfolio, because the market has been good, you relax a little. Treat yourself. Take the vacation. Give a gift to the grandkids. You are not chained to one number forever. You adjust as life happens. Research from Morningstar showed that retirees who use guardrails can actually start with a slightly higher withdrawal than the old rule, while keeping the same safety level. Caroline loves this approach. It gives her clear signals. She does not have to guess or worry. The numbers tell her what to do. Solution 3. Wait to claim Social Security. This one costs nothing. Literally nothing. Here is how Social Security works. If you claim at 62, you get a reduced payment forever, up to 30% less than your full amount. If you wait until 67, your full retirement age, you get 100%. If you wait until 70, you get 124%, a permanent bonus of 24%. And every year you wait past 67, your payment goes up by 8%. Guaranteed. Not 8% if the market cooperates. 8%. Guaranteed by the United States government. There is no safe investment in the world that guarantees 8%. For Caroline, delaying from 67 to 70 raises her monthly benefit from about $1,700 to about $2,100. That extra $400 per month is permanent. It goes up every year for inflation. And it means $400 per month less that she has to take from her portfolio during the dangerous early years. Less portfolio withdrawal means less sequence risk. Think of Social Security as building a floor under your life. The higher you build that floor, the less your portfolio has to do. And the less your portfolio has to do, the safer it is. Solution 4. Build a guaranteed income floor. This is the big picture idea that ties everything together. The safest retirements are not built on one thing. They are built on layers. At the bottom, guaranteed income. Money that comes in every month no matter what the stock market does. Social Security. A pension if you have one. An annuity if that fits your situation. That guaranteed layer covers the basics. Rent or mortgage, groceries, utilities, healthcare, the non-negotiables. On top of that, your investment portfolio. Used for the things that can flex, travel, dining out, gifts, fun. If the market has a bad year, you pull back on the fun stuff, but your lights stay on, your fridge stays stocked, your life stays intact. For Caroline, at age 70, her Social Security will cover $25,200 per year. Her essential expenses are about $33,000. The gap is only $7,800 per year, less than 1% of her portfolio. 1%. The sequence risk that nearly sank her plan? It now only applies to her fund money, not her essentials. That is the power of a guaranteed income floor. 6 months after she retired, Caroline sat down and watched a video like this one. She called her daughter that evening. Her daughter helped her find a fee-only financial planner, someone who charges a flat hourly fee and does not earn money from selling products. Someone who would be completely honest with her. They spent 2 afternoons working through everything. And here is what Caroline's plan looks like now. She moved $76,000 out of her investments and into a high-yield savings account. That is her 2-year cash buffer. She does not touch it unless the market drops significantly. She set her withdrawal rate at 3.8%, not 4%. She set her upper guardrail at 5.2%. If she ever hits that, she will cut spending by 10% that year. She set her lower guardrail at 2.9%. If she hits that, she can spend a little more freely. She decided to wait to claim Social Security until she turns 70. Between now and then, she draws about $22,000 per year from her portfolio as bridge income. Very manageable, very conservative, and she mapped out her income floor. At 70, Social Security covers most of her basics. Her portfolio covers the rest, and it does not have to work very hard. Her retirement plan is now $6,000 to $8,000 per year more expensive than the original plan, but it is also honest about the world she actually lives in. Caroline called me last month. She said something I will never forget. She said, "Samantha, I do not have more money than I did before. I just finally understand how to use what I have. That is it. That is the whole thing." She did not need more money. She needed a better plan. Let me make this very simple for you. Wherever you are right now, here is what to do. If you are in your 40s or early 50s, run your retirement projection with 3.3%, not 4%. See what that number gives you per year. Compare it to what you think you will need. The gap tells you how much more to save, and you still have time. If you are in your late 50s or early 60s, start building your cash buffer now, before you need it. 2 years of essential expenses in a safe savings account. This is your sequence risk shield. Also, go to ssa.gov and look up what your Social Security benefit would be at 67 and at 70. Write those 2 numbers down. The difference between them may surprise you. If you are already retired, look at your portfolio balance today, not what it was when you retired. Divide your annual withdrawal by your current balance. That is your current withdrawal rate. If it is above 5%, you need to adjust. And if you have not claimed Social Security yet, consider waiting. Every year from 67 to 70 adds 8% to your guaranteed income for life. Let me say one last thing about William Bengen. He was a smart man. He did real important work in 1994. The 4% rule was genuinely helpful for a generation of retirees. But he built that rule for 1994. He built it when bonds paid 7%, when stocks were reasonably priced, when people planned for 30-year retirements, when inflation hit retirees the same way it hit everyone else. That world is not the world of 2025. But here is the good news, and I want you to hear this clearly. You do not need more money than you have to retire safely. You need a plan that fits the world you actually live in. A cash buffer costs nothing extra. You already have the money. You just move it. The Guardrails system is just a way of being honest with yourself about how life changes. Delaying Social Security costs nothing. You just wait. And the income floor is built from what you already own. Caroline did not find extra money. She reorganized what she had. And she went from worried to settled. That is what this video is for. Not to scare you. Not to make your retirement feel impossible. to show you that a plan built on honest information about the real world in the real year you are actually retiring is within reach. Go build yours. If this video helped you, the one that goes perfectly with it is the Social Security timing video, specifically the math on claiming at 62 versus waiting to 70. That single decision can be worth $150,000 or more. It is linked right here. Subscribe so you never miss a video. I will see you in the next one.